Good morning and welcome. I'm Giancarlo Grasso, Director of Strategy and Business Planning at AMCHAM Korea. Thank you for joining us today. Our webinar today is part of a joint committee series hosted by the Taxation and CFO committees related to filing individual tax returns in both the United States and South Korea. Part 1, which is today, will focus on questions related to filing individual tax returns in the United States. And then Part 2, which will be hosted in May, will focus on points of consideration when filing Korean tax returns. The Taxation Committee regularly provides information relevant to members related to changes in tax policy and tax regulations. The CFO Committee is a forum to identify and discuss issues impacting CFOs in South Korea. AMCHAM continually strives to improve business and trade relations between Korea and the United States, and we provide valuable content to our members through webinars such as this one. If you have questions during this presentation, please use the Q&A function at the bottom of your screen, and the questions will be addressed at the end of the presentation. Now I'd like to turn it over to Jeremy Everett, co-chair of the CFO Committee, to introduce our speaker today.
Thanks. I've known Jay for, I guess, 22 years. He has over 30 years of international tax and tax controversy experience, and I've had the privilege to kind of follow him along in my career. We've never worked at the same firm at the same time, but we've worked at literally the same firms at different times. He's been the chair of the AMCHAM Taxation Committee now for over 20 years. And currently he's senior counsel at Lee & Co. Previously, he was the leader of the international tax team and also served as the co-head of the tax practice group. Jay specializes in international tax planning, structuring, and dispute resolution. He serves, again, as I mentioned, as the chair of the AMCHAM Taxation Committee, but also as the chair of the Taxation Committee of the Inter-Pacific Bar Association. He's a member of the International Fiscal Association, the American Bar Association, and the International Bar Association. He regularly contributes to tax journals and legal publications on Korean and international tax developments and trends. And he's a great speaker to have, a great topic, and I'd like to turn the mic over to Jay. Welcome, Jay.
Jeremy, thanks so much for that introduction. Thank you to AMCHAM for this opportunity. I've been asked to do this presentation by the leadership of AMCHAM because we always cover corporate issues, complex tax issues, and the like. But since AMCHAM and myself personally, we're getting so many questions about individual U.S. taxation from the U.S. expatriate community that live in Korea, and these questions often are the same type of repetitious questions that we get from time to time, and so we thought that it would be useful to our community, our AMCHAM community, to address some of these issues. So I put together, it's not comprehensive, but I did put together some of the key issues that appear to come up over and over again. So without further, I'm going to put the screen on for my slides and start my presentation. Right, here we go. So I hope you can see this. If not, I'm sure Jeremy will let me know. I titled this presentation as what U.S. individual tax filers need to know, but just simply were too afraid to ask. I might add that many of my friends are asking me these questions, but I suspect there are many others who are facing some serious and potentially significant U.S. tax issues, and they just have not confronted them. And so hopefully this will give them an opportunity to think and plan and to comply as appropriate. So let me start with the easy items first, and we'll then get into more complicated and complex issues. Just so that so we're all on the same page, I think in terms of the questions that I get all the time is that, hey, is the tax filing deadlines for this year again similar to last year, when due to COVID-19 an extension was provided to file the tax return? And as you can see at the bottom of the slide, the answer is no. For 2021 tax return, which is due this year, as you'll see from this slide, the rules go back to the way it was previously. And this is whatever I said for the past 2 minutes, they're not important, so don't worry about that. We will now talk about things that are more important. So let's talk about these easy and simple stuff, if you will, first. For US filers who reside in the US, of course, the filing deadline this year for last year tax return, 2021 tax return, is April 18, 2022. And reason for that, of course, is under the US tax rules, to the extent that the filing date falls on a weekend or holidays, then it's the next working day, which is 18th. I just might add that if you do live in Maine and Massachusetts, because of the holidays, local holidays there, you have 1 day extra. Now, many of you have asked me, hey, how do I file an extension? Well, the extension is rather straightforward because US tax system, as a general matter, provides automatic extension. So in the case of a US resident, US tax filers who happen to be in the US, you receive an automatic 6-month extension by filing Form 4868. It's a simple form. Many of you have done it before. Don't be afraid. It's a very straightforward, and now it's an electronic process. In addition, you can apply for, and it's generally granted. I would say that it's rare that that the IRS would say, no, sorry, I won't allow an additional extension. But as a general matter, additional 2-month extension will be granted by filing a simple letter to the IRS. And typically they won't respond. So you just want to keep that letter. If they're going to reject it, then they'll send you a letter saying, here's the reason why we rejected your additional 2-month extension. Now, for most of you who are US filers residing in Korea, that is to say outside of the US, many of you know this already, but the deadline for filing is not typically April 15th. You get yet a 2-month extension to file from that date. So typically, for those of you who are working and residing outside of the US, I mean everyone from the US who are working in Korea as we speak, the deadline for filing their individual tax return is June 15th. So it's 2 months more. That said, if you're going to file an automatic extension, you don't get the 6 months, you only get the 4 months. So that if a US resident filers and US non-resident filers are filing automatic extension, you end up basically in the same place, October 15th. And again, an expat can request 2-month additional extension by writing in. There's a little tip that I want to give everyone. Many would say, oh, gee, how do they know that I'm actually residing outside of the US? There isn't a special box or anything. If you go through return, of course, there may be enough indicia of living abroad that may allow the examiner to come to that conclusion. But what I do, and what many of us who are in this business would do, is we would actually put it on top. You can type in, if you're submitting by paper, then you write in, you would say that the filer is a non-resident or residing outside of the US. And that way, they'll know. Another way, of course, Another obvious way, I should say, is that the address itself of the tax return will indicate that the person is living outside. So most of you are filing from Seoul or Korea will show the filer's address as being in Seoul, Korea. So I think that addresses the first question that we always get. And so I repeat, this year, there's no COVID-19 hardship extension for filing the tax return. All right, so let's move on. Okay, what is the questions that I use? So what's the effect of filing the tax return? Why is it important to file a tax return? And we'll get to the penalty issues and so on and so forth. But in my view, the most important one, of course, is that if you don't file, there's no statute of limitation that would run out, and IRS can come after you at any time, forever, effectively. And of course, just if you were to file fraudulently, you have the same effect. But the beauty of filing a tax return is that generally, the clock would tick from the time that you file for the IRS, if they wish to examine your return for 3 years. And that 3-year rule would only be extended to so-called 6-year rule in the event there is a substantial understatement, underpayment and understatement of income. And substantial is 25% or more. So if you were reporting $100, you should be reporting $100 of income, but you reported $75, $74 should be more than 25%. So let's say $74 of income, then the 6-year statute of limitation would apply. In addition, for a lot of you who are generating foreign income, additional 3 years apply. So the 6-year statute of limitation would also apply to the extent that your foreign income is understated by now only merely $5,000. So that's something to be understood. Most of us who are living and working in Korea, who are US filers, will invariably be subject to 6-year statute of limitation. So please take note of that. The additional issue which I'll get into in later slide is that to the extent that you don't file your return, then of course you're not filing your FBAR or FATCA forms, which if you don't and potentially are subject to those filings could raise substantial penalties and even criminal penalties. So it would be, let's say, just basic best practice to file the tax return, even if you don't have any income tax due, right? Most, I shouldn't say most, many expats working in Korea who are, who are teachers, who are educators, who are on secondment for, say, 1 or 2 years, may not look at the filing as a big issue, because they would say, oh, I read about the foreign earned income exclusion. It's adjusted every year, and I heard that I can exclude under this Section 911 foreign income exclusion up to $108,000 and $108,000, and therefore I don't need to file because I don't have any tax liability. Technically, that's true. In addition, of course, the so-called Section 911, in addition to excluding the foreign earned income, there's also an element for foreign housing, and that's capped also every year. For 2021, it's $38,000 and change. So many would say, oh, I only earned $140,000, including income and housing. So I don't know any taxes. I don't have to file. But as I say, there's two problems with that. One, the statute of limitation would never run. And secondly, the critical FBAR and FATCA forms that I'll be discussing later in the slide will be required to be filed, and the non-filing or delinquent filing could trigger considerable issues, as I will discuss in a minute. All right, on to the next slide. The one question that I get a lot these days, and I think it's because, well, frankly, there is a lot of generation transition that's taking place. Many of us who are ethnic Korean or Korean Americans who immigrated or who are second generation or third generation still may have a lot of relatives in Korea, maybe their grandfather or grandmother or you know, distant relatives and the like, and you know, they're in an age where they're going to start passing on or start to be involved in estate planning, and what we're seeing is a lot of gifts being made by Koreans to U.S. filers. Just to be clear, when I say U.S. filers, we're talking about U.S. citizens, green card holders, and those who have substantial presence in the United States. It's what I call tax resident. You're a tax resident, first of all, if you spend more than 183 days in a given year. You can also be a tax resident if you generally spend more than 90 days per year for the past 3 years. Aha, you didn't know about that, right? So those of you who are spending, say, 3 months a year and have spent 3 months a year for the past 3 years, do ask your tax advisor if you could be treated as a substantial if you had a substantial presence, and therefore you would be considered a U.S. tax filer, right? The good news, of course, in fact, it's all good news. You know, I would say, hey, you know, be happy, be merry. If you have a distant relative or your dad, mom, grandfolks are giving you, you know, $1 million, that's great. It's wonderful, right? And what's even better is that there's no gift tax due on that on that gift that you received or bequeathed. You know, I think it's important to recognize, and many people ask me, it's like, oh, I don't want to file anything, I don't want to do anything because I don't want to pay any taxes. The point is that on the U.S. gift tax system, it's the giftor, the donor, who are subject to gift tax, not the recipient, not the donee. So to the extent that they have no U.S. connection, the ones who are making these generous donation would not be subject to U.S. tax net. And all you need to do is report that. So the question is, why not? And I don't know why not. I keep on telling people that it's innocuous and just do it. Now, there is some threshold that should be noted. The threshold amount is $100,000 if the gift you receive is from an individual, a natural individual. So that's a substantial amount. So to the extent that you only receive $90,000, yes, there's no filing. That's okay. But if you have $90,000 from one donor or giftor, and another person were to give you $11,000, then you need to file, because collectively, combined, they would exceed $100,000, right? So that's something to also to take note of. In addition, if, for example, you're getting gifts from a foreign entity, which may be owned or set up or established by a relative or someone who wants to give you a gift, in that case, the threshold is much, much lower. That would be $16,815. This part actually is adjusted from year to year. One of the things that you should note is that filing a gift tax return, which you do under this form 3520, as you can see from this slide, is something separately you file from your income tax return. And the address is different too. So one thing I always do advise those individuals who are filing US tax returns, but also are receiving these gifts and also need to file 3520, just so that you don't get a strange letter saying, hey, you filed your 3520 too late. And you're like, hey, wait a minute, I extended my return to October 15. So I filed this on October 15 as well. Why am I getting this? They may not know that because the person who are reviewing your form 3520, in fact, may not know that your tax return, or you filed an extension to your tax return. So there's a little box to tick. It's box 1K of 3520. Do check that, and then they will know. Okay. Note that at a minimum, if you're required to file and you don't file it, the failure to report gift can result in significant penalties. And we're just starting off with what I call 25% of the value gift penalty. There could be others as well. If you're doing it for fraudulent reasons, there's some tax avoidance reasons, other penalties can apply, to be sure. But just saying, I decided not to file it. I'm not going to file it. That can trigger the 25% penalty, and that's not some tax amount. That is on the gross amount. So if you're getting, say, $1 million of gift, that's $250,000 right off the top. So I urge you to think about that. All right. Well, I know this is a topic that I'm getting a lot of calls on, and unfortunately, after I have a big discussion with these individuals, they would just raise their hand and say, I'm not going to do anything. I'm not going to file anything. In the past, I think you can get away with that, but it's clear as of 2019, which is the first time we have seen this. I don't think that it's a good idea to take that path anymore. And why is that? Because question on Form 1040, page 1, at the very top now, and since last year, in 2020, I think it was in 2019, it was in another box somewhere else in a different page. But since 2020, year before, and the tax return due this year, which is 2021, now it's very prominent. You'll see on the top, and the question is, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in virtual currency? So, if you, obviously, if you say no, that could result in significant civil and potentially criminal penalties. But if you say yes, then you're going to have to disclose and report your transactions. Now, just before I go further, I want to point out that there's a lot of discussions and a lot of misunderstanding relating what virtual currency is. It's really not a currency at all, right? It's got nothing to do, or completely unrelated to the fiat currency, Korean won, US dollar, whatever that may be. It's just a terminology that I use for these digital assets. And indeed, at least for US tax purposes, different countries have different rules, but for US tax purposes, these virtual currencies, cryptos, if you will, and the non-fungible tokens, or NFTs, are simply property. And many of us in this business would say, yeah, that's probably the right classification. And because they're property, they're going to have a cost basis or acquisition basis. If you buy one Bitcoin for $10,000 and you're to sell it for $50,000, well, your basis is 10, your your gross proceed is 50, net of 50 over 10, 40 would be your gain, and that would be a gain from a sale exchange or otherwise disposition of a capital asset. Now, same rules that you know already relating to selling of property would apply. Investment property would apply to the taxation of cryptos. If it was held for less than 1 year, well then it would be taxed as at ordinary income tax rate based on your brackets. So if you're in high brackets, you could be taxed at up to 37%. If you're in low tax bracket, you may not get taxed at all, to 0 or something in between. But if you did hold a crypto for 1 year or more, then you would get capital gains tax treatment, which until there is a discussion, of course, as many of you know, there may be a change, but as we speak, and certainly for last year's tax return, the tax rate would not exceed 20%, plus the Obamacare taxes, it would be 3.8%, right? So in my example, if you had $40,000 of gain, you would pay 20% on that $40,000 to the extent that you've held it for more than a year, and then you'd also pay 3.8% of that gain on top of that. So it's in some ways it's simple, but what drives everybody crazy is this: many have actually used cryptos to buy things. And they think that, oh, let's say I bought a painting for $1 million. Or we don't have to be so, work with such a high number, $100,000. We bought a beautiful painting for $100,000. And you say, okay, I'm done, right? I have $100,000 painting, and then, wait 5-10 years. It's gone up to $200,000, and I'll pay tax on that $100,000 gain, right? Well, what about the gain on the crypto, or the loss, as the case may be, on the crypto that you use to purchase that asset, right? You need to account for gain or loss. And those of you who are involved in frequent trading of cryptos, buying and selling and buying and selling, as you'll note from my slide, I'll read this. I hate reading slides in these kind of presentations. It drives me crazy when people do that, but I'll do that from time to time. And here, there's a couple of things that I do want to point out in this slide. What happens if gains and loss and gains and loss, this crypto and that crypto? Some of these guys, they are doing crypto trading every day, every week, every month. And at the end of the year, they end up with this amazing amount of transactions that they can't figure out, right? And that's still a problem. That's still a problem, because you need to account for gain and loss for all of those items. And that's different than securities, right? Because in securities, you could have, for example, the wash sale rules. You can have constructive sales rules. Wash sales, for example, those of you who know, would mean that, if I had shares in Samsung Electronics and I bought it for, $100, and, it went down to $50, let's say. And so I said, you know what, I'm going to sell it. And I want to take $50 of loss. And then, you wait a couple of weeks and you bought those shares again because, hey, I changed my mind. I'm going to buy it, and I'm, bought it at $60. And you say, oh, that's great. I can still use my $50 loss against some other gain. Wrong. The wash sales would say, if you buy, if you sell something and you have a loss and you bought the same securities again, then it would be as if you never sold those shares. So you would not be able to write off those losses. So let me read a couple of things for you. Effective January 1, 2024, this is very, very important. Any person who actually act as a broker, they're going to not from 2024, they'll be required to provide you, issue a 1099-B. So all of your problem on one hand is solved, right? But on the other hand, those of you who are trying to, forget to report cryptocurrencies, you won't be able to do that because you will be issued a 1099, which goes to the IRS. So on one hand, those who are complying, you're going to say, great, thank you. I don't have to do all that calculations anymore. On the other hand, those of you are saying, oh, I'm not going to report it. Well, you'll have to, because 1099 will be issued from 2024. Another interesting point to take into account is that those of you who are going back and forth from US to Korea and back and forth, and who hold cash, remember, you always have to declare, right, what you have, to the extent that you're taking more than $10,000 in cash, right? Well, guess what? The rules are going to now apply to cryptos as well. So the existing rule providing that taxpayers who receive over $10,000 in cash in the course of taxpayer trade or business report the receipt thereof to the IRS on Form 8300 shall now apply to receive digital assets. So you don't even have to be a broker. You're just, you and Joe Schmo, counterparty, buying and selling cryptos. You guys gonna have to issue Form 8300 with each other, even though you're not broker. And to the extent that you do a conventional transaction to a broker, as I say, from 2024, you're going to have to, you will receive Form 1099-B. And of course, if you're a broker, if you're an institutional broker, then you have this obligation. And as I mentioned already, there are proposals also. I don't know if it's going to get passed this year, but there are proposals to apply the wash sale rules, which I just mentioned, and constructive sale. Constructive sale rules is similar to wash sales. Is that, for example, what if you have an ETF that substantially has in its portfolio IBM shares and Samsung shares, let's say, and if you're to separately sell your IBM and Samsung shares, could you be subject to the wash rule, to the constructive sales rules? There are cases around that and other similar issues that would arise there too. All right, let me just move on to this topic. I'm actually bringing this from experience. I remember some 20 years ago when I first came to Korea, and I was working from another country, and I'm a U.S. Citizen. I woke up one day and I realized that, oh my God, I have to file a tax return and pay taxes in a UK jurisdiction that I worked at before I left mid-year. And then I have to file a tax return in Korea because I'm, obviously I started working in Korea and generated income, but I'm also a US tax payer, right? So I remember I was saying, I work Monday and Tuesday to pay Korean taxes, and Wednesday and Thursday to pay US taxes, and Friday, I'm paying taxes to yet a third country, and whatever I left, my wife will take it all. So what's the point? Should I just quit working? That was my first line there. But no, I decided to keep on working, and the reason for that is because there are rules available to provide some relief against what I call multiple taxation, right? But just to step back for a minute, let me just explain the basic rule, and many of you are aware of this already. I mentioned this already. U.S. citizens, green card holders, and certain tax residents are subject to US tax on a worldwide basis, irrespective of where they're living and where their residency may lie, right? But then, so you have to file a tax return. Then US tax filers who are also working, for example, and residing in Korea, many of you who are watching this and sitting in, and participating in this webinar are also subject to Korean personal income tax, as if in the same way as your Korean national counterparts, right? So technically, and it's not just technically, it is the rule. For Korean purposes, they say, hey, you're a resident, file a tax return. And in the US, they'll say, hey, you're a US tax filer, file a tax return. What do you do, right? Now, historically, that was not a major problem because until 2018, the tax rates generally in the US were higher than in Korea. And many of you who are working and residing in Korea were also allowed to file a tax on what's known as flat tax regime, which is 19% flat tax regime, as many of you know. But of course, the flat tax regime has been substantially carved back so that it only applies to certain type of individuals having stayed in Korea for a certain number of years. And at the same time, Korean domestic rates have gone up over the past several years, while US tax rates, as I mentioned already, from 2018 has come down. So you can see the slide at the bottom of the slide, the top individual tax rate in Korea, for those of you who are lucky to be taxed at that rate, I have to say, will end up paying 49.5%. So, I guess great that you're making that much money, but then half of it will go to Korean government, right? Perhaps more if you're filing, also if you're subscribing to Korean national pension, as well as Korean health insurance, et cetera, it could be even higher. Now, in the US, the top tax rate for the past several years have been capped at 37%, right? And as I mentioned already, those individuals, those are actually everyone who are US filers and living and working in Korea can make themselves available of FIE, the Section 911 foreign income exclusion, which allows you to exclude up to $108,700 in earned income plus housing allowance, which is adjusted every year, as you know. For 2021, that amount is $32,610, so it's about $140,000, as I said. But hey, all these taxes that I'm paying in Korea, well, how do I deal with the fact that in the US, I have to separately pay a tax return, albeit I may be subject to a lower tax rate? Am I screwed, right? And the answer is, well, since US rules is such that US citizens, green card holders, and tax residents are required to file a tax return, regardless of their residency, as I mentioned. If a country of residence, i.e. Korea, taxes you, the only way to prevent the potential double taxation is by claiming a foreign tax credit in Form 1116, okay? And so that decreases, but not totally eliminates the pain. So in this case, if you paid substantial amount of tax in Korea, and then Uncle Sam says, hey, you also need to pay, so much tax, up to 37% on that income that you earn, the way to deal with that is by filing Form 1116, the foreign tax credit form, which would provide that the taxes that you paid in Korea would be given dollar for dollar is a foreign tax credit against any tax liability that you may have in the U.S. As I say, in the old days, that worked out to be great, right? To the extent that Korean taxes paid were lower than U.S. tax liability, you would take full foreign tax credit, and if you need to top it up a little bit, you'll top it up. But the problem is that, as I mentioned, U.S. tax liability, what happens if U.S. tax liability is substantially lower than your Korean tax liability? Using my example, let's say on $1 million of income, you paid $500,000 in Korean taxes, but you're only subject to, say, $370,000 in tax in the U.S. Of course, it'd actually be lower because of, in both cases in Korea and in the U.S., if you apply the graduated tax rates, it'll be marginally lower, but I'm just using a simple number just as an illustration purposes. So against $500,000, I have $700,000 of U.S. taxes due, right? Well, all that means is that I'll get a foreign tax credit of up to $370,000. The additional $130,000 of Korean taxes that you paid, sorry, you can't get a refund. You can use that as a carry over or carry forward item in your tax return. You can go back 1 year or you can go forward 10 years. That's the rule. So hopefully someday when you're not in Korea and you're generating substantial amount of income in the US or elsewhere in other jurisdiction, and the taxes due in the case of US tax, of course, you can apply these credits in the case that you're working for another country and the rates are lower, so that you would need to pay additional taxes in the US. You can then use the unused, what we call excess foreign tax credit against the tax liability, when that's generated in the future. I used a simple example in the bottom. You can look at it, or those of you have already read it as I was trying to explain the rules. So I'll just move on. All right. Originally, my presentation was about FBAR and also FATCA form 8938. But because I wanted to harmonize the presentation with the CFO committee, I decided to cover obviously much broader topic. That said, the genesis of this webinar really stems from many of you who've had issues or having issues or will have issues relating to reporting and disclosing foreign accounts. And unfortunately, it's a problem that many of you are facing. I would say that it's becoming more increasingly important because US has started to crack down on non-filing delinquent filers for the past couple of years, and some are sensational. People are going to jail, having to pay substantial amount of penalties, which I'll explain in a minute. So, it's something that you really can't ignore anymore. For many, many years, in fact, there's a lot of litigation around mea culpa. I didn't know I had to file, even though they may have been advised by their tax advisors or accountants to file an equivalent form to the form that I'm going to be talking about. The old form, as you know, the old FBAR form, as you know, was called TDF 90-22.1. Now it's called FinCEN Form 114. To go back then, take one step back here. let's just have a quick review of FBAR. And it's now embedded in your Form 1040, Schedule B, Section 3, Question 7A, right? You have to say yes or no. At any time during 2021, did you have a financial interest in or have a signature authority over a financial account located in a foreign country? And if the answer is yes, U.S. filer must now report foreign financial account. I shouldn't say now, they have always been required to file this form, except that, form has, the rules in the form has changed just a wee bit. You now need to file the FBAR, what I call FBAR form, which is based on FinCEN Form 114. FinCEN, by the way, stands for those of you who are interested. It's based on the U.S. Bank Secrecy Act, and that's Financial Criminal Enforcement Network. Okay, so let's get to the meat of it. Who's required to file an FBAR? Well, basically, it's what I've explained to you so far as the U.S. filer. To the extent that U.S. filer has outside of U.S. a financial account that exceeds $10,000, you're going to have to file FBAR. It's just simple as that. I put definition in the bottom. That's not really important for us. The important thing is you now have to file this form, FBAR form, with your tax return. In the old days, as you know, it was a separate form. You filed separately with separate deadline. So hence hundreds and hundreds of litigation that arose of the past decades saying, oh, I didn't know about this form. I filed it. I lost it. I swear to God, I filed it, et cetera, et cetera. My dog ate it. I filed it, but my dog ate it. My cat chewed it up, whatever. But now it has to be attached and has the same deadline. It follows the IRS individual tax return Form 1040. So really, there's no excuse. To the extent that you meet the monetary threshold, you will have to file this form. Okay. Well, the question is, if I have a bank account, or if I have a financial account, what do I, is there any way that I can have somebody else hold it for me and say it's really not mine? But as you know from the prior definition, the definition is very, very broad. So that you, a U.S. filer, would have a financial interest and therefore obligations to file FBAR just by being a mere owner of record or holder of legal title over these accounts. So this is really strange, right? Because most of you know of U.S. tax rules to be substance over form oriented. But here's a classic case where it's form over substance. And therefore, to the extent that the owner of record of these accounts who are acting as agent, nominee, attorneys, et cetera, or on behalf of the person who should be filing, what I call a U.S. filer, also is required to file. So this is something that many intermediaries, I think that's a term that are used frequently to describe these kind of people, they are also required to file. It's quite onerous, as you can see. Not only that, and indirect ownership will also catch you, right? You'll say, hey, you know what? I don't have any foreign. But I do have a company that I set up that owns a account, or maybe it's not even as nefarious. Maybe I'm doing business and I have a real genuine entity that I set up in some country because I need to do that to run my business. And of course, that company will invariably have bank accounts, right? It's just quite normal. To the extent that I control that company, that is to say more than 50% own, I'm an owner of more than 50% in that company, then guess what? That company also need to file as well. So this is quite onerous. And I use other examples in the slide. It doesn't have to be a company per se. It could be a partnership. It could be any other kind of entities, any other legal as opposed to a natural person would be subject to the same onerous rules to the extent that you're in control. By the way, I don't deal with foreign trust ownership issue because that's under a separate body. And the short answer is yes. If you set up a foreign trust, you're going to be subject to even more onerous filing requirements and reporting requirements. I'll just leave it at that. All right, let me just move on. If you do have a foreign account, a foreign financial account, well, what types are we talking about? What kind of assets are we talking about? So the ones that are rather obvious to you is the bank account, right? But there are others. For example, securities accounts. So even though we frequently talk about banks, if it's a foreign brokerage account that have securities or even derivatives or even financial instruments like options and et cetera, then that would be subject to reporting as well. Not only that, as you can see, commodity futures, I already mentioned options, insurance policies that have cash value. So for example, a classic one is whole life insurance policy, where you can redeem it, at any time and then get cash for it, right? That'll be included. And this is a tricky one. Mutual funds or similar pooled funds that may be generally available to the public. Now, I would have to say that, and I won't go into it here, there are a number of other rules that's already widely known to US filers who are investing in foreign mutual funds that would require you to file. Jeremy, are you there?
Yeah,
Okay.
Jay, we've got a few questions. We may not have time to cover them all, but would you be able to wrap it up in maybe the next 5 minutes or so we could try to ask maybe one question or so?
Yes.
Thanks.
I will wrap it up in 5 minutes. Let me just move on. I do want to say that in those kind of situations, there are other backup filing forms that already exist in the US tax rules, including, for example, PFIC forms and the like, 5471. These are things that you should also discuss with your tax advisors to the extent that they're required to be filed and you have investments in foreign mutual funds. I also want to point out that not all investments are treated as financial account. For example, the hedge funds and private equity funds, to the extent that they are reporting they have a separate obligations. They're not required to be reported. Let me just try to wrap up ASAP. Non-filing of penalties. I mean, it's common sense, right? You're going to be subject to potentially significant civil penalties, and the top line should just catch your attention. The maximum civil penalty is $100,000 or 50% of the balance of the account. But guess what? That's for 1 year for one account. So if you have multiple accounts and multiple years, you know how much that could be, right? Do the math, right? It could be significant. I do want to say that there are rules that says that, if it wasn't willful, if I didn't do it intentionally, then you shouldn't be subject to more than $10,000 violation or penalty. And you can even negotiate for less. criminal penalties, I won't even go there, right? I mean, it's very big right now in the U.S. There's a lot of litigation, people going to jail and losing all their, they have millions and millions of dollars in their foreign bank account. They're losing it all under various penalty scenarios. So I will also pass through that. This is something that I do want to spend just 1 minute, if I may, and then I'll try to wrap it up very quickly. There are ways to cure. There are ways to come clean. And there are at least 3 ways to do it. One is what I call streamlined procedure. The other one is the disclosure procedure. But most importantly, the one on top, that's just a procedure relating to filing delinquent tax, delinquent FBAR form. If you have just filed all your tax returns correctly and everything, and you just forgot to file the FBAR form, then it is possible to avoid all kinds of penalties to the extent that it wasn't willful. But I do mention there are other type of ways to cure the delinquent filing. One of them, of course, in the case of those of you who are actually foreigners, that is to say, you are Korean citizens, but happens to be U.S. tax resident because you are green card holders or you're a tax resident, there's a way to actually avoid all kinds of penalties, even if you didn't file FBAR form. And there are voluntary disclosure forms. Finally, this is what I wanted to cover, 30 seconds or less. Form 8938, so-called Statement of Specified Foreign Financial Assets. People get confused about this form with FBAR. It's a different form. This is what many of us call FATCA form. And this is a separate form you have to file. And the threshold is different. I'll just mention that for those of you who are residing outside of US, you get a break. The threshold is only if the combined value of foreign assets worth more than $300,000 or $600,000 in case of joint filers at any time during the year would be subject to this particular form. Here in the US, this lower. In terms of reporting, very, very similar, and to the extent with your advisor, they will know. Again, the risk of penalty and get hit with $10,000. Much everyone. I really appreciate that on sitting through this boring topic, and that you follow. I'm easily accessible. Just find me and that's email. Thank you very much.